Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today, we're talking about the top 5 risks of running a business on a handshake with Rachel Partain. Now, she is a partner at Forchelli Law, specializing in complex tax advisory and tax controversy services. She guides businesses in structuring transactions to be tax efficient and handles general corporate and transactional matters. Rachel represents clients at every stage of federal and state tax disputes, including audits, appeals, litigation, and collections. Recognized for her expertise, she holds an AV preeminent Martindale-Hubbell peer review rating and is frequently quoted in national publications. Rachel is also an accomplished author and speaker on tax-related topics. Larry, take it away.
Rachel, thank you so much for joining us. I know Matt kind of gave you a little bit of background on kind of what you do, but why don't you kind of tell the audience in your own words what you really do, what your background is, before we talk about the risks of running a business on a handshake, which I still can't believe people do, but we'll get into that. So give us a little bit of background, and thanks for joining us, Rachel.
Absolutely. So I've been practicing for over 2 decades. I have an LLM in tax. So I'm predominantly a tax attorney. But in representing businesses, I've obviously morphed into representing, businesses and in regular transactions, anywhere from forming a business, operating a business day to day, or big inflection points for a business, and then ultimately, usually sell side exit of the business or taking on new owners. And then on the tax side, it's anything from advisory, as well as controversy, as Matt noted. So IRS audits, New York State audits typically are the main focus.
Right. So anyone that has a tax issue or a tax situation, call Rachel. But let's talk about the 5 risks of running a business on a handshake. First of all, in this day and age, how common is this, Rachel? Do you still see people doing this?
Constant. It is a constant. It's shocking, frankly. I mean, we see businesses that form on LegalZoom, right? They just get a basic kit. They don't do an operating agreement. And now, which is fine if you're going to start it up and things are running, but you want to bring in somebody else? Well, where's your document? How are you running? How is this? Or a concern comes up, right? Our manager is ill. We need to replace a manager. How do we go about doing that? Well, you don't have an operating agreement, or we're going to take on a new investor. Here, they give us a check for $20,000. Okay, well, are they a member? Are they an owner? Are they getting shares? What's their interest? What's the profits and loss distribution? It happens all the time. I see it all the time.
Yeah, so the people are just starting a business with another person, and they don't even bother getting any type of legal data to say, let's go ahead and do it, and we'll worry about anything else later on. Okay.
Yeah.
So that must lead into a lot of different problems and issues. So let's talk about some of them. So what are the economic and maybe management risks of doing business with a handshake?
Sure. Perfect example in New York, there's the limited liability company law. So specific to LLCs under New York State law. The default rule for an LLC is that profits and losses, distribution, and management member voting rights are all based on, as reflected on the books of the company. And this is, again, assuming you don't have an operating agreement and you're in default rule land. The standard is that it's based on the values of the contributions of the members as reflected on the books of the business, which sounds fine if you have 50-50, we each put in cash. But if you have a service partner and you haven't reflected what the value of those services are on the books of the company, which, by the way, you wouldn't, like, why would you ever think to say, oh, your services are worth X? Then automatically that service partner is lopsided in the value that they've contributed to the company, which means that their distributions of profits, losses, voting rights, everything is decreased based on what the partners agreed at the time.
Yeah. So, but even going back further, how does somebody, you got 2 people, they want to start a business together. don't they need to at least have an EIN number or a social security number? I mean, how do they even?
Yeah, so you can form a company super basic, right? Articles with the state, get an EIN number, done. I mean, that's really all you need to have a business, right?
Okay, so you have an EIN number, but you're saying you don't have any agreement, you have no handshake on how the business is gonna work, and they just go ahead and do that, and they'll worry about that later on, is what you're saying. Okay,
Right.
now,
Like an agreement. I mean, they're operating fine in the beginning. You're going to provide services. I'm going to provide the money. We're going to split 50-50, done. And that's fine when it's working, but it's not fine when it isn't. Right. So, and that's the problem, right? Like, you have to plan for what is when it isn't, in case it isn't, right? You have to think ahead. This could be an issue between my partner and I. We could bring in a new partner. Like, you have to document these things sort of, and I'm not talking about like 30-page, 40-page agreements, right? A 3-page operating agreement, but it should at least say profits are 50-50. You know, we're forgetting the New York statutory defaults, and this is what we're going to operate our business by.
so so one of the risks that you kind of alluded, about is kind of transactional risk. What do you mean by kind of transactional risks?
Sure. So you're going to take on a loan. What are they going to do? The lender's going to do due diligence, but on what? Right? You don't have an operating agreement. You don't say, maybe you're a member managed or a manager managed company, but you never have the operating agreement to tell them who the manager is. So who's signing the loan document? I mean, something as simple as that. Like, if you don't have if you say you're a manager managed and you don't name a manager in a piece of paper, then the bank is not going to know who's going to sign the document, sign the loan, or who has the authority to bind the company. Or worst case scenario, the default rule is member managed. So say you have 4 people, you form an entity. If you don't say manager managed, each and every one of those 4 people can bind the company to something, and the other 3 people may not even know about it because they have that power under state law.
So, but when they've started this and you declared an EIN number, have you listed all the people in there? You don't even have to list the name of the people in there.
The EIN form asks for the social security number of one responsible person, but that's vis-a-vis the IRS. That's not vis-a-vis state law, third parties, interacting with your entity, providing funding, or if your entity is going to be sold, right? The buyer is going to do due diligence on who the owners are, what the percentages are, and if there's no documentation, how are they going to know?
Right, but how does the accountant do even books when there's no company along those lines?
Well, presumably the CPA, like the owners will tell them, this is what we agreed to, a 50-50 split, and that's fine as long as, like I said, everybody's getting along. But as soon as you typically a minority, a service partner, owner that says, hey, no, we got this payment in, I should get more of that. And now you have like a conflict or a dispute. Now you've triggered, a potentially litigious situation because you haven't put sort of your operating parameters down on paper.
Right. And of course, it becomes a bigger problem if the 2 partners or multiple people want to split. I guess it's like getting married and you don't have any agreement or prenuptial set up. So
Yeah.
if you want to split, so now what happens? What are some of the risks of creating something like this? The business has grown and somebody's unhappy and there is no agreement. I guess you would try to work something out, and if you don't, you go to court. Is that the kind of?
Yeah, I mean, so I call it like business divorce, but really it's shareholder dispute and business divorce, right? Maybe they're going to continue on. They just need this point hammered out. But yeah, I mean, you've essentially bought yourself a ticket to court and the attorney fees that go along with it.
So what are some of the other business succession risks that you see without having an agreement?
Sure. So you take a multi-generational, founder-based, business where, the founder's up in years, right? They're managing their business. They were the founder, and they may have given off pieces, and there may be some people working, family members working for the business, but really it's still the founder's business, right? If that founder dies and there's no plan for who's taking over, if say it's a manager managed entity, or say it was a corporation and they were the president, secretary, like all the positions, right? And they just up and die without having on paper the plan for the entity. Sure, they need a personal plan, but I mean, we're just talking about for the entity. Who's the manager? Who's signing checks the next day? Who's responsible? And if you don't have that in your corporate documents, you're now going potentially through probate, and you're having heirs fighting over who's controlling the business.
Right. So yeah. So without having any type of an agreement in there, none of you have to worry about if you split up. You have to worry about if somebody gets, I guess, not only dies, gets sick, and there's nothing in there on how to address all that.
Right.
So and I guess part of the planning ahead of time, and I don't know if they would discuss this with you, but based upon the type of business, I guess would determine sometimes what type of entity that they should form. So kind of like what would be some of the entities like that it would make sense to do, I guess, an S corp or an LLC or a partnership. So those conversations, do they have those conversations with you beforehand to see what works better?
Yeah, so that's like my primary value add when someone's about to form, like before you hit LegalZoom, like before, and please don't use LegalZoom, but before you hit form, right? Like, should you be an LLC? Should you be a corporation? Right? That's like your basics. Generally, you can file as a partnership under state law, but and it would really be a limited liability partnership, right? But the two entities predominantly, right, are LLC and corporation for state law. Right, then the next question is, now what should you be for tax? Because you can elect S corp as an LLC, and you can ask S corp as a corporation for state law. So it's really, do you want to be an LLC? And that's really mostly where we do I do tend to recommend clients form. But then, yeah, the next question is, do you want to be a C corp? Do you want to be an S corp? Or do you want to be a partnership pass-through entity?
Right, but so obviously it's better to figure out one of those corporations and do one of those than have no agreement in place. And depending upon, I guess, the business will depend upon which of those makes better sense for them.
Yeah, for example, if you're going to be in a real estate entity, you will be an LLC taxed as a partnership, period, end of story, right? You will never put real estate in a corporation. And if you don't get that advice beforehand and you check, oh, we should be a corporation, and you just put real estate or purchase real estate with a corporation, like worst case scenario.
Why is that? Why is that?
It's just for tax purposes, a C corp or an S corp is taxable itself. Now, the C corp actually files a return and pays tax, and then separately, when it dividends income out to its owners, they also pay tax. An S corp pays tax on its assets, which just means eventually its shareholders do, but there is a sort of a tax charge on the sale of assets. A partnership doesn't have that. So you would never want to put a taxable property into a corporate solution. Now, I know a lot of people had to back when there was no LLCs. It's a relatively new creature of statute. But currently, if someone says I'm doing real estate, the answer is LLC.
Okay. So, I mean, can you give us like some examples that you've seen that people have come to you and they set up the wrong corporation from a tax situation, or they didn't have an agreement and out there, and what some of the problems that you've faced?
Issue that crossed my desk was a pre-existing business 100% owned by one person. So it was a disregarded entity for tax purposes, and she, ran everything. She needed a little bit of funding. She got some funding from a new investor, and that was it, right? Oh, thanks for the money. All right, so this is like, you're like a 10% owner now. Thanks, but no documentation on the business itself, no documentation of the new money that came in, no documentation that the money wasn't a loan, that they're now an owner with owner rights and member voting and profit distributions. right? So if you can't prove you're a shareholder and owner of a business, then you've really just given them a loan or potentially even a gift. So you kind of need to document, I'm an owner, or this is a loan, right? You can't, a loan is another example. How many times does, a related party send money, loan money to a business, or one related business loan money to another related business, right? If you're not documenting those as loans, right, you're going to get into some trouble, either IRS audit, interest charges, like who should be paying interest and who should be booking interest expense. So that's a particularly recent example that came up.
So we talked a little bit about taxes, but so what are really the tax risks for not setting up a corporation, just acting with a handshake?
Sure. Well, the number one risk is going to be a tax audit, right? So you're running your business, everything's fine, you're paying expenses, paying wages here, you're doing marketing expense here, you have meals and entertainment, you have all these categories of expenses that are totally normal to a business. If you haven't documented any of that, then the IRS is going to come in on audit and zero all of your expenses out. And by zero, I mean literally all. Like if you're, let's take a Schedule C, which is an LLC business disregarded for tax purposes because it's as if the owner is running the business himself. I have seen literally countless IRS exams where they take all of the Schedule C expenses and just X. And then,
is it too late at that point to do anything?
It's not too late, but unfortunately, you've made it more difficult for yourself, right? So you're going to have an audit level where you lose, and then the IRS is presumed correct, and it's the taxpayer's burden to show that the IRS is not correct and that you did in fact incur those expenses. So now you're going to have to appeal it. So you're going to go to the next level above IRS exam, which is IRS appeals. And usually that's where I'll be like, obviously companies have employees that they've paid. Like obviously they've had marketing expense, right? So that's where you'll get a reasonable person, but it's going to take time to get there, and you're going to have to provide as much documentation as you have. So it's going to be a fact finding, a persuasive presentation to IRS appeals, and you're not going to get 100%. Because, like meals, entertainment, travel, there are certain categories where if you don't keep documents, the IRS is right. You're not supposed to get anything. A travel log, if you have mileage reimbursements, meal expenses, you're supposed to say who you were with and when and why, right? So you'll usually get haircut, but you can win on audit and if on appeal. But worst case scenarios, you're going to actually have to litigate it in tax court.
So that's one of the risks, that they deny deductions for you. What are some of the other tax risks?
You have expenses you can lose. You can have you could have done shareholder loans, and the IRS will say it was really equity, so the company loses out on interest expense. If you're not, for example, bad debt is another area. If you're not documenting the steps that you're taking to try to collect your receivables that you then ultimately write off, they're going to say that you haven't done enough. So really at every stage of operations is, and I'm saying again, like it's short, hey, we tried to contact you, we couldn't collect. Like we looked at, you went bankrupt. Like it's just, you want little, documentation trails of how you're operating to support the positions you're taking on, your financials, your tax returns, your members. If you have a bunch of members, I mean, they could ask about it too. Like, hey, like, are we documenting that this, $20 million loan was really bad debt? So there's a bunch of risk issues in tax. It's not only IRS, but it's predominantly IRS.
And then the last risk is, litigation risk. So how does kind of litigation risk come up when you don't have a corporation or operating agreement?
Sure. So we mentioned this earlier, that, your point about, what do you do when there is now a dispute between shareholders? Like you're going to have to go to court to resolve that. But the number one risk of all, if you don't keep proper documentations, there's this concept called piercing the corporate veil. And what that is when you form an LLC under state law, that's limited liability company, right? You've now shielded your personal assets from your business assets because New York State provides a limited liability for that company. Same with a corporation, right? You have limited liability. If you don't treat your entities properly, which means the things like having agreements and having boards and holding meetings and minutes, and if you are not operating in good faith, essentially with your entity, then there's a risk that a court would say, this wasn't really an entity to begin with, it was really you, and they'll what's called pierce that veil of limited liability of the company and come after your personal assets directly.
Whoa.
Yeah. So that's like on a scale of bad to worse, like we hit worse.
Yeah. So, and I'm guessing that most people don't even think about that, because if they did, just the liability there, they wouldn't make a move without making sure that they have something set up. So I guess, are you seeing this kind of in the beginning stages, or you're getting called into situations down the road to try to help them resolve the issues?
Yeah, it's usually when an issue happens, right? Because if everything is operating according to plan and everyone's still on the same page, their handshake is fine for them, right? So it's usually an issue has happened, either a minority service partner, an IRS audit has happened, or some dispute. The business could go bankrupt or out of, insolvent, or, say it was a restaurant up the street and they just close up, right? What's now the rights and the obligations of the managers and members now to, sort of clean things up so that the entity is closed out properly and they don't have individual liability for business assets, business liabilities.
So in summary, if you had to kind of just summarize, some of these risks and some of the things that somebody should be doing, what would you suggest?
So definitely have an operating agreement or bylaws for a corporation and a shareholders agreement at a minimum. And it doesn't have to be long, but just get your agreement, whatever you handshaked on, get that on paper.
Yeah. So if you're sitting out there and you're listening to this and you're hearing some of these risks and liabilities, and you're one of those that have a business without an agreement in there, I would strongly suggest you give Rachel a call to get your ducks in a row and get yourself protected to minimize these five risks. So Rachel, where can somebody go ahead and reach you? It's the easiest way of somebody to reach you.
Sure. Email is always the easiest. And I think it's in the materials, but otherwise it's pretty easy. It's maybe not so easy, Partain, so Partain, at Forchelli, which is Forchelli, law.com.
Right. Rachel, thank you so much. I've learned a lot today about the different risks on here. I hope some of the audiences learned about the risk. And if you're, like I said, if you're sitting there thinking about starting a corporation, would be even better to speak to Rachel's, because then you can really plan ahead and put the best one together. But if you have one out there, much better to get a hold of Rachel and figure this out now before a situation arises. So thanks again, Rachel, for joining us.
Appreciate it. Thanks so much.
If you have not subscribed to the podcast yet, make sure that you do by just hitting that subscribe button. And if you know a business owner or somebody who might have been terrified by what you just listened to, and I'm sitting back thinking to myself, oh my God, am I making any of these mistakes? If that thought crossed your mind at all, make sure that you share this podcast and, of course, share Rachel's contact information. So for Larry and Rachel, this is Matt Halloran, and we'll see you on the other side of the mic very soon.